This is Nightly Business Report with Tyler Matheson and Susie Garrett. Brought to you by...
Sailing through the heart of historic cities and landscapes on a river, you get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
Tale of two techs. Struggling smartphone maker Blackberry finds a buyer. On the same day, Apple reports record sales of its new iPhones. So where did one go wrong and the other right?
Waiting on Washington, 1 week away from a possible government shutdown. What the stakes are for your money.
Real estate's new frontier. Why this traditional industry is using a modern way to raise funds from the public on the internet. All that and more tonight on Nightly Business Report for Monday, September 23rd. Good evening, everybody. I'm Sue Herrera, filling in tonight for Susie Garrett.
And I'm Tyler Matheson. Welcome, everyone. Well, we begin tonight with big news in technology. The struggling smartphone pioneer, Blackberry, may have just received the call it's been waiting for. The one-time tech giant getting a lifeline from a consortium led by Toronto-based Fairfax Holdings, which would take Blackberry private in a deal worth about $4.7 billion. Fairfax already owns about 10% of the company's shares, and after news of the deal halted trading for about a half an hour, shares of Blackberry ended 1% higher on very heavy volume, still shy of the $9 a share that Fairfax agreed to pay. Not a done deal yet, not by any means. The consortium has 6 weeks to conduct due diligence, while Blackberry can shop around for a better offer, if it can find one.
Joining us now to talk more about Blackberry is Peter Missick. He's Senior Technology Analyst over at Jefferies. Peter, welcome. Pleasure to have you with us.
Thanks for having me.
What's your take on this particular deal? It seems to me it's kind of putting a floor under the stock so that the market can't push it any lower, certainly, like it did last week.
That it's going to do, but also importantly, operationally, it's going to allow them to continue to sell their services. It's that service business, the idea of controlling and managing iPhones and Android devices, that's really the future of the company. And for that, they really need to assure people they're not going to go away and that they have the money to withstand, and this allows them to do that.
We dangled the possibility, Peter, that there might be some other bidder out there over the horizon. Do you expect that, and who could it possibly be?
We don't see a bidder for the whole company emerging. We think there are bidders for the services business that I outlined earlier, but that would be, one segment, and it would be very difficult to extricate given that you already have a bid on the table or potential bid on the table for the whole company.
Do you see any problems with the due diligence period and with those who are going to be doing the financing?
It's tough to see how Prem Watsa, who's the chairman of Fairfax, would have difficulty in due diligence. He was on the board of Blackberry up until a month ago. He saw what was going on. He knew the handset business was terrible. So it'd be tough to see that. We think in terms of how they're going to structure this, they're going to try and put leverage or debt on top of their services business. And there we think they could probably raise somewhere in the neighborhood of 2.4 to 3.5 billion. So it really means that Prem Watson Fairfax has to add 1 to 2 billion of equity to get this deal done.
Where did this company go so terribly wrong? 2008, 2009, they were kings of the world, Peter.
Absolutely. The big mistake was sticking with an operating system that was way too old, that didn't allow web browsing, and really didn't support apps, and they ended up getting crushed. It just goes to show you have to innovate very quickly or die. And they should have launched these BlackBerry 10 devices 2 or 3 years ago. They might have had a shot then. Now it's game over in that handset world.
Peter, how do you see this company, say, 2 years from now? It's going to be taken private. As you said, it will give them a chance to reorganize their business and perhaps give those corporations who were worried about not having BlackBerry around maybe place some orders because now they won't be in the public eye as much. But look out 1 or 2 years, and what do you see for BlackBerry?
They're going to be one of the top cloud, hybrid cloud providers and the top mobile device management providers in the world. They'll be securing BlackBerries. They'll be securing, more importantly, iPhones, Androids, and iPads. And they'll be allowing you all the access of your desktop in a really secure, data-compressed fashion, and in a way that the NSA probably can't snoop. So we see a lot of value in that service.
But will people still carry a device branded BlackBerry in 3 to 5 years or not?
Probably very small number of people, only those that are absolutely 100% wedded to just making small messages, emails, texting, or phone calls. Anyone that requires any apps of any kind will not be carrying a BlackBerry in the future.
All right, Peter, thank you very much for joining us. Appreciate it. Peter Missick, Senior Technology Analyst over at Jefferies.
Well, it was a very different story today at Apple, which has regained a lot of its polish today. That's because Apple sold a staggering 9 million of its newest model iPhones over the opening weekend, nearly doubling analyst forecasts. The company even issued a more optimistic outlook for the current quarter. Take a look at how investors reacted. They sent shares about 5% higher today, $23 higher to be exact, at $490.64. Josh Lipton has more now on Apple's most successful iPhone debut yet.
Apple's stock moving higher in today's trade. It's after the company reported selling way more new iPhones than analysts had expected. Demand for the 5S with its new camera and fingerprint technology exceeding supplies. Also, 200 million downloads of iOS 7, that's Apple's new mobile operating system. Gene Munster of Piper Jaffray saying the report does answer some of the criticisms Apple had faced about the pace of its innovation.
There's been a lot of questions about innovation, and I think that they've addressed a lot of that just by the demand. You know, it's all about what's on the come, and it looks like they've got some good things on the come over the next year and a half.
With such strong numbers, Apple now telling investors to expect the higher end of its estimates for the fourth quarter on revenue and gross margins. This was a big beat for Apple. Analysts had estimated that the company would sell around 5 to 6 million devices. Amit Dayarnani of RBC says many analysts had thought there wouldn't be too much demand for the 5C and that supply constraints of the 5S would limit sales. But Dayarnani now says that worries about declining profit and sales next year are off the table. Apple's broader strategy, he says, focusing on profitability rather than market share, does seem to be working, at least for now. For Nightly Business Report, I'm Josh Lipton in San Jose.
Also basking in the glow of those blowout iPhone sales, some of Apple's top component suppliers. Take a look at how shares of chip makers Cirrus Logic and RF Micro Devices and some of those other suppliers did today, banking on strong sales of those new iPhones in the quarter ahead.
Well, with so many investors focused on BlackBerry and Apple today, it was easy to overlook a new product launch from Microsoft. Despite slow sales of its first-generation tablet, the new Surface Pro 2 was unveiled today. It comes with a much longer battery life, powerful new energy-saving chips, and a full version of the upcoming Windows 8.1 operating system. It retails for $899. Now, there is also a cheaper version called the Surface 2 for about half that price.
On Wall Street, the major averages closed lower for the third session in a row. Stocks were in a sort of holding pattern as traders worry about bickering Washington lawmakers as they try to hammer out a deal on a federal budget and on the debt ceiling. All of that amid the looming threat of a shutdown of the government 1 week from today. Today, the Dow fell 49 points. The Nasdaq was down 9, despite getting a lot of help from those shares of Apple, and the S&P was lower by 8.
Well, as Sue just mentioned, the countdown for a possible government shutdown is now just 1 week away. And the big question in Washington is, are lawmakers any closer to reaching a deal that would keep the government up and running? Or is it looking more like a stalemate? John Harwood joins us now from Washington. John, where do we stand on this budget showdown?
Tyler, I don't think we're any closer to a deal than we were before, but I do think there is some expectation that we will get a deal in the end. I say that for this reason. We've just had announcements today that two Republican leaders in the Senate, Mitch McConnell and John Cornyn, say they're not going to join Ted Cruz, the senator from Texas, in filibustering the bill that came out of the House the other day that would extend government funding and defund Obamacare. The plan by the Democrats in the Senate is to take that bill up and then strip out the Obamacare provision, extend the government funding, send it back to the House and challenge them. The fact that that bill will not be successfully filibustered is a sign that the bill is going to land back in the House's lap right up around that deadline at the end of September. And Democratic leaders in the Senate are betting at this stage that the House leaders will put that bill on the floor and will extend government funding. We'll see if it plays out that way. We won't know for a few days, but that's how they think right now.
You know, that's encouraging, John, because it looked like this was really going to go right down to the wire. There was so much animosity between both sides of the aisle and both houses that I find that quite encouraging. I would think that that would calm down some of the market volatility.
Well, either way, we're going to go down to the wire. And even if we avoid a shutdown, that is by far the much less consequential of the two deadlines we're facing. The more important one is the debt ceiling, which is in the middle of October. And what we've seen is a two-stage Republican strategy. One, to defund Obamacare in this bill. That's going to fail. Then they're going to try to delay the law for a year in a debt limit bill. That is also going to be resisted doggedly by the president and by Democrats. So they're going to have to find a fallback there, too. That's going to be a harder one for the Republican leadership to pull off. And we'll see if we can pull off this one, the more limited one, next week.
Very quickly, let's say the bill goes back to the House minus the defunding of Obamacare. And then the House has to pick that up. What do they do? And do they try and send yet another bill back with some sort of condition on it? And is there a condition that would pass the House Republican caucus that doesn't involve doing some kind of harm to Obamacare?
There is the potential that the House could pass the bill with a different rider on it, aside from defunding Obamacare, some tweak like attacking the income verification provisions, which are lacking, or repealing one of the taxes in the law. I don't think the Senate would accept that. And the chances are, if they're jammed right up against the deadline, they may have to act very quickly and extend government funding and live to try to fight on the debt limit.
John Harwood. John, thanks for uncomplicating a very complicated topic tonight. We appreciate it. There was a lot of uncertainty over the Federal Reserve's next move today after some mixed messages from top Fed officials. William Dudley, president of the New York Fed, said the timeline for scaling back the bank's massive stimulus plans is, quote, still very much intact, end quote, as long as the economy keeps improving. But then Richard Fisher of the Dallas Fed said the central bank's failure to taper its bond buying last week put the Fed's credibility into question. And he also said the White House has terribly mishandled the process for picking the next Fed chairman and called frontrunner Janet Yellen wrong on policy, but said she'd still make a great chairperson.
Still ahead, Wall Street pay. Many believe it encouraged excessive risk-taking that led to the financial crisis. So 5 years later, how have things changed, if at all? But first, a look at the international markets today. Chrysler files for an initial public offering for up to $100 million in common stock last week. We told you this was coming today in a regulatory filing late this afternoon. We also learned the IPO will take place in the first quarter of next year and that J.P. Morgan will be the sole underwriter.
Some good news for drivers. Gas prices are heading lower. According to the Lundberg survey, the price of a gallon of gas fell about 6 cents over the past 2 weeks, falling to $3.52 a gallon on average. San Francisco has the highest price in the lower 48 states, averaging $4.01 a gallon. And Charleston, South Carolina, as if it's not beautiful enough, has the cheapest gas at $3.14 a gallon.
General Motors is buying back a large chunk of its own shares. The bailed-out automaker is going to purchase nearly half its preferred shares held by the United Auto Workers Healthcare Trust, paying $3.2 billion. Now, to purchase those 120 million shares, GM plans on issuing a corporate bond offering. Meantime, just today, Moody's Investor Services upgraded GM debt, rating it, taking it out of junk status and moving it into investment grade status.
It often pays to be CEO, even if your company isn't doing all that well. Stephen Elop is the departing chief executive of Nokia, the struggling Finland-based phone maker that was acquired by Microsoft earlier this month. After just 3 years in the corner office, a time in which Nokia's share price plummeted and its share of phone sales took a nosedive, Elop will earn $25.4 million when the company is folded into Microsoft.
Well, for many investors and regulators, outrage over exorbitant Wall Street pay was the fuel that fed the fire that led to the financial meltdown. Many believed sky-high paychecks for top executives encouraged the excessive risk-taking that led to the near collapse of the economy. But just like the financial services industry since the crisis, Wall Street's pay has been downsized and restructured. Mary Thompson has more.
It's lunchtime at Harry's Cafe and Steak in New York City's financial district, and business is brisk.
I think the mood on Wall Street is good. It's still not where it was. I don't know if it ever will be.
A lot on Wall Street's changed since the financial crisis, including the spending habits of the traders and bankers. General Manager Jean-Baptiste Caillet says frequent the restaurant.
Harry has one of the best wine collections in New York. So we would see bottles of wine at $5,000, $8,000 for lunch. That was a very common occurrence at the peak. Today, it's rare.
Wall Streeters' relative thriftiness reflecting changes to their paychecks since the bubble.
We don't have the huge bonus potentials that were there before, virtually unlimited in some respects.
Compensation consultant Dave Schmidt says while Wall Street remains well paid compared to Main Street, overall pay is down due to a struggling economy, weaker bank profits, board's concerns about shareholders voting down compensation packages, and disclosure and reporting requirements mandated by Dodd-Frank. How much has pay fallen? The compensation firm Johnson & Associates predicts this year it will be 39% below 2007's record levels.
There's less tolerance for underperformance. Businesses or individuals who don't perform just don't get paid.
Consultant Alan Johnson is the dean of Wall Street compensation. He says not only are Wall Streeters making less, they're getting less of what they earn in cash bonuses, even as salaries are higher. Salaries rising to make up for a greater portion of total pay being issued in performance-based stock vesting a few years out. To critics of Wall Street pay, Johnson says the changes have addressed one of their chief concerns coming out of the financial crisis.
There's so much focus and there's so much transparency. Certainly pay today isn't encouraging excessive risk.
Keeping checks on the paycheck paying off by limiting risk. For Nightly Business Report, I'm Mary Thompson.
And we begin Market Focus tonight with a look at Citigroup. According to the Financial Times, the third largest U.S. bank saw a significant drop in trading revenue during the third quarter, and that could hit its earnings. The report says Citi has the biggest exposure out of any U.S. bank to the emerging markets, which have seen capital flight and currency fluctuations recently. The bank had no comment on the report, but the stock finished the day 3% lower at $49.57. JCPenney reportedly looking to raise more money. According to reports, the struggling retailer has met with banks in recent weeks about possible fundraising options. The stock, one of the worst performing in the S&P 500 today, dropped more than 4% to $12.36.
A rough day for shares of Pandora, the internet radio company coming under pressure after Apple said that over 11 million unique users have already tried its new iRadio service. One analyst believes Apple's entry into streaming radio will reduce Pandora's current listening hours by roughly 10% over the next 6 months. The stock fell 10% today to $24.26. And ISIS Pharmaceuticals rising on positive results from one of its experimental drug trials. In a mid-stage trial, the drug was able to substantially reduce blood fat in patients who suffer from a rare genetic disorder in which the body does not break down fats correctly. Investors drove the stock up almost 7% to $38.48.
Well, starting today for the first time in 80 years, private companies, including hedge funds and private equity firms, can solicit investment funds directly from accredited investors, that is, those with a net worth of over $1 million. And that could mean big changes in the real estate industry as it turns to a favorite tactic of startups, crowdfunding. Diana Olick has our story.
It's happening here in Washington, D.C.'s H Street corridor in Northeast, a transitional neighborhood that still has a ways to go. Areas like this are not exactly favorites among large-scale real estate investors. Smaller, local investors know their potential, but until today were largely shut out. Now, crowdfunding real estate is about to get easier.
Public will help you build your real estate.
Ben Miller has already been crowdfunding commercial real estate through a tricky exemption in the law. His company, Fundrise, brings small local investors to projects like this soon-to-be D.C. restaurant and market. It was limited to locals, but starting today, he can market to investors anywhere.
Over time, you'll realize that the public is an incredible partner, incredible asset. And when you democratize investment in real estate, not only you get capital, but you actually get a social power that wasn't possible before.
While Fundrise's investors have paid as little as $1,000 for a share in the building and its revenue, the new rules allow national marketing only to wealthy investors. But that restriction is set to disappear soon, too.
You're going to see ways to refinance the money out. You can sell the property. You get distributions from cash flow. I mean, you become like a landlord, like playing Monopoly.
It may be like Monopoly, but investors may also be playing risk. Critics argue that as regulations disappear and investing in real estate becomes as easy as buying a book on Amazon, some people might not get what they paid for.
Properties that don't exist, that's even more of a problem because there's no guarantee that someone can't raise money and never actually see any construction take place.
But with the doors swinging open, developers are flooding in. Prodigy is working on a project in downtown Manhattan, and Realty Mogul has also launched a website for investors. While Miller began as a developer, he's now focused on Fundrise's web platform, which is now giving 50 developers in 16 cities the ability to crowdfund at a click. For Nightly Business Report, I'm Diana Olick in Washington.
And to read more about crowdfunding in real estate, head to our website, nbr.com.
Coming up, the digital revolution, which companies win and which lose as more advertising dollars flow into mobile. But first, how commodities, treasuries, and currencies perform today.
Last week's devastating floods in Colorado, which claimed 7 lives and destroyed thousands of buildings, could end up costing homeowners, businesses, local governments nearly $2 billion. That's according to Equicat, a company that estimates damages for the insurance industry. The firm also says that a high percentage of the losses may not even be covered by insurance. Meantime, the number of people unaccounted for is now down to just 6, while recovery teams search over nearly 2,000 miles of damaged areas.
A planned merger in the airline industry just had its December 17th deadline extended. U.S. Airways and American Airlines are moving their planned merger expiration date back by another month, giving each carrier more time to deal with an antitrust lawsuit filed by the Justice Department to block the merger. The trial is set to begin on November 25th. The government says that the combined airline will hurt competition, leading to fewer choices and higher ticket prices.
Meantime, an industry group now says airlines will make less money than predicted this year. The International Air Transport Association, which represents as many as 200 carriers, cut its profit forecast for the airline industry this year by nearly $1 billion to just under $12 billion. They blame slowing growth in emerging markets, a decline in demand for freight shipments, and higher fuel prices. But the IATA sees nothing but blue skies ahead for 2014, predicting a rebound in profits to total $16.4 billion, thanks to rising consumer and business confidence and lower fuel costs. And if you are seeing more ads when you turn on those tablets and e-readers, there is a good reason for that. At the annual Advertising Week conference in New York City, advertising agencies, ad platforms, and big brands are gathering to figure out the best way right now to reach tech-savvy consumers. Julia Borston takes a look at the big digital shift in advertising.
The mood at Ad Week is upbeat as U.S. ad spending is on the rise, driven by a surge in digital, as advertisers are drawn to the advantages of targeting and measuring ads' impact. Traditional media can't always deliver that detail as newspapers, magazines, and network radio suffer steady declines.
Digital is growing at a rate of about 15% a year, whereas all measured media is only growing at about 3%. So there's a big shift, and within digital, the two components that are growing the fastest are mobile, which is up over 100% a year, and video, which is up about 30%.
That's thanks to surging internet use. The time people spent online grew 86% from June 2010 to June 2013, with more than half of internet use now coming from mobile devices.
And now there's more proof that mobile ads really work. ComScore unveiling a study today that finds that people who see mobile ads are 28% more likely to want to make a purchase than those who don't see the ads.
The CEO of ad conglomerate Interpublic Group says the transformation is all about the explosion of valuable data on how to reach consumers.
You can buy audiences, you can target market at the extreme, and that's what this is all about. Our business is about communicating and messaging and telling stories.
That's good news for digital ad platforms which specialize in targeting, especially to mobile, from Google and Yahoo to Facebook and Twitter, which today unveiled a new partnership with CBS.
It's a win-win-win situation. And I know that sounds cliche, but what can you not like about CBS Interactive's ability to send out tweets in real time on the world's biggest and most exciting social platform?
Twitter ads are designed to work well on mobile devices, and mobile ads, despite their fast growth, are still just about 10% of all digital ad spending, which means room for major growth. For Nightly Business Report, I'm Julia Borston in Manhattan.
And finally tonight, it's the end of the road for an iconic vehicle. As of December 31st of this year, Volkswagen is ending production of the VW bus, the vehicle of choice for generations of surfers and hippies and growing families everywhere. Brazil is the last place in the world where Volkswagen still makes the van, but the company says it would be too costly to change production to keep up with new Brazilian safety regulations for airbags and anti-lock brakes. Volkswagen produced more than 10 million buses over the past 63 years, and many of them, even ones that are decades old, are still on the road.
Always wanted one of those. I wanted my dad to buy one. Never had one.
No. I had a VW Bug, but not a van. All right, that's Nightly Business Report for tonight. I'm Sue Herrera. Susie's back tomorrow. Thanks for joining us.
And I'm Tyler Matheson. Thanks for watching. Have a great evening, everybody. We'll see you back here tomorrow night.
Nightly Business Report has been brought to you by
Sailing through the heart of historic cities and landscapes on a river, you get close to iconic landmarks, to local life, to cultural treasures. Viking River Cruises, exploring the world in comfort.
I'm Tyler Matheson with a Nightly Business Report news brief. Blackberry got the call it was hoping for, agreeing to sell itself to a group led by its largest shareholder, a Canadian private equity firm. The price tag, $4.7 billion. Apple sold far more than the expected 9 million new iPhones this weekend and raised its outlook for the current quarter, shares up 5% today. Stocks did fall, though, as traders worried that Washington lawmakers appear no closer to reaching a budget deal that would avoid a shutdown of the government in 1 week's time. The Dow down 49, almost 50 points. The Nasdaq lost 9.5, and the S&P 500 was lower by 8. Chrysler filed the paperwork to begin selling stock to the public again, aiming to raise $100 million from investors. Walmart, for its part, is going to take on 50,000 temporary workers this holiday season. And tune in to Nightly Business Report here on your public television station.